3 inside and outside bar trading strategies that you can apply right away. Hello, welcome back, and again thank you for supporting the last few videos. The support, the likes, the comments are just mind-blowing. Thank you for that, keep it coming, and I will keep the channel ads free. I also got asked a lot about what is the best book about technical analysis, and luckily you have come to the right trading YouTube channel, because I wrote an Amazon best-selling book. It's called Technical Analysis Masterclass. A link to the Kindle and to the Amazon version is in the description below, so make sure to check that out. And let's talk about inside and outside bar strategies. I have prepared 3 strategies to cover a really broad spectrum of market action. So we're going to take a look at reversals, trend continuations, and breakouts. But first of all, let's recap what is an engulfing or an outside bar, what is an inside bar. So both patterns, inside and outside bars, are 2 pattern candlestick formations. So we need at least 2 candlesticks to find such a pattern. And when we look at the outside bar, it's also often called an engulfing bar. And the first one is very, very small, or it's just smaller. And the second one is completely engulfing. It's completely outside of the range of the first candle. And this can be a momentum candle. It is often a reversal sign, and it can also be used for breakout and continuation trades. So a very versatile and a very, very important candlestick. Inside bars are as well 2 candlestick patterns. And here it's exactly flipped around the opposite way. The first candle is usually the large one, and the second one falls into the range of the previous one. So the second candle is inside of the first candle. And it means that the market is slowing down, the momentum is slowing down, and we can use it across various trading strategies. So the first one, we are going to take a look at reversals. We're going to look for a slowdown and then for an explosion in momentum. So here we have the first example, and very, very important, we can find inside and outside bars all over the place, but to really make sure that you are better at screening markets and that you are improving and increasing the chances for finding high probability trades, we want to look for candlestick formations that happen, first of all, after a long trending period. So we're going to stay away from range markets. We're going to look for them as breakout points, and we're also going to look for them around important support and resistance levels. So here we have a strongly downwards trending market, and then here after this huge bearish candle, the market just completely died down. There was no momentum afterwards. You can see those 3, 4, 5 candles, they all fall in the range of the previous one, and especially those 2 here. Right after the bearish candle here, you would expect more follow through, because obviously this should signal a lot of selling pressure, but it did not. And the market just completely died down. This is a sign that the sellers are not as strong as this candle may make it look like. So this is a first heads up that, okay, this is not going to be a very, very strong selling market. So if you are short positioned, you should think about maybe exiting your trades, and then you can start looking for trades into the opposite direction. Here is then our outside bar. So we go from long candle to inside bar and then to outside bar into the new trend direction. So really, really key reversal sequence, and you will find this very, very often across various chart patterns and trending phases. Here as well, that we stay away from range markets, and then you can see first the market is in a strong uptrend. After this long bullish candle, the market died down. We have 2 inside candles, and here is a special inside candle. This is called a doji, which means that the market is completely flat. It opened where it closed, so no momentum and very high uncertainty about market direction. And then the next candle is the exact opposite. We have first a rejection here at the highs with a very long candlestick wick sticking out, taking out the previous high, and then the close is very low, so it shows momentum pushing into the downside, and it's completely engulfs the previous candlestick action as well. So really, really important candlestick figure as well, and the context always matters. Most traders make the mistake of trading candlesticks isolated, but that is a big mistake. And candlesticks alone are not important enough, they are not strong enough, but if you put them into the right context, maybe you look left and see, okay, where did this happen? Was there a previous resistance level that maybe caused the market to turn? Then this could even further improve your chances of finding high probability trading opportunities. Here as well, we look for an uptrend, and then during the uptrend, we wait for inside bars, which show that the market is slowing down, or we look for outside bars into the new direction of the reversal trend. So here the market shot up, and then here at the top, we suddenly see a huge engulfing candle, which we haven't seen before. And it shows us not only that the uptrend doesn't look very strong, but it also signals that maybe it's time to look for bearish trades. And you can see afterwards we have another rejection candle, where the price tried to move higher, but the seller stepped in and drove the price down. And then afterwards the market completely sold off. Then here we have a little bit of a pullback period. So and we can put this and should put this into the context. Strong selling pressure and then weak pullback. So not a lot of buyers compared to this one. And especially here at the top, we have a few important key candlesticks. We have first here a rejection. The market tried to push high and then closed very, very low. We have an inside bar where the market then died down. And then after the inside bar, we have an outside bar, which signals that not only can we now put things into context and see that the momentum to the upside is losing, and also now we have exactly the opposite, that the pressure to the downside is increasing, because this obviously is an outside bearish candle, and it could signal that here then the market is sold off. Let's take a look at trend continuations and other examples. So during a trend continuation, you could use, for example, also a moving average to help you find and to determine the trend direction. And what you want is that the market is trading on one side of the moving average, and then as a trend continuation trader, you want to wait for consolidations or little pullback periods. And then in those pullback periods, you want to wait for momentum again into the trend direction. So you can see after this breakout, the market traded higher for a bit, slowed down. We have some inside candles which show that, yes, there is a consolidation, but there's also not a lot of selling pressure. And then here suddenly the market shot up, made a higher high here, and then continued. This is a very, very classic trend behavior. We have an impulsive move, then a small consolidation, and then a continuation that was triggered with an outside bar. Here as well, the market went from uptrend to then breaking below this longer term moving average. We have your first trend wave, and then here in this pullback period, we have multiple small bullish candles which are not really looking too threatening for the bearish move here. So obviously this bearish move looks much, much stronger than this pullback. And then here you have then a very strong bearish engulfing candle, which engulfs the previous two candles, shows a lot of strength to the downside, and could help pinpoint continuation trading opportunities into the trend direction. Here we have multiple outside bars that would have been able to been used to time continuation trades. So the market traded below this long-term moving average, then it reversed and crossed above the moving average, and then we have periods where the market moves higher, then small consolidation, and then the impulse into the trend direction often happens with an outside bar. So you can see inside bar, outside bar. The trend continues. We have an inside bar, the outside bar, inside bar, outside bar, and this is a very, very common behavior in the markets. Sometimes those pullback or consolidation periods take a little bit longer, but if you then see that an outside bar is the trigger to show you that the market is breaking into a new high, this can be used for trend continuation trades. Here, final example, the market was in a sideways pattern, then broke out, started this new trend below the moving average here, and then you can see small inside bars, many inside bars after in a row, and then here rejection candle with an outside bar, move lower, small pullback, outside bar which signaled a break into new lows, and then the trend continued. So very, very common market behavior that you will see across many time frames, many asset classes. The breakout buildup, which is one of my favorite setups, what you have is usually a trend that then loses strength. The market trades within a pattern. It can be a double bottom, can be a double top, it can be a head and shoulder, and you have a very well-defined support and resistance area usually. And before the breakout into the new trend, you often have a buildup. I talked about this in a previous video. I think it's one of the most important patterns that you can try to study. And it signals that the market moved into the level, and whereas previously the market sold off strongly away from the level, now the price really stuck to the level, and there was not a lot of selling pressure. And then once the breakout happens, we can put this all into a nice context and identify high probability breakout opportunities. This is something that we traded together in our masterclass. There's a link in the description also below to the masterclass where you can learn to trade one of those strategies and many more of those that I trade and Moritz trades. Here, another trade that some of our masterclass students took. The market was in an uptrend, then the uptrend paused, went into a double top, and then before the breakout you have a small inside bar, you have a rejection candle here, and then you have your outside breakout bar. The market moves lower, consolidates a little bit, inside candles, and then huge push to the downside. So really, really common behavior as well. And although small inside bars before a breakout are not really enough to forecast or to predict a breakout, if the breakout happens and if you can before the breakout see such small inside bars, then it can help you with confidence in the trade signal. So here as well, this is something that I am still in. The market has moved up very nicely from this pattern. The market was in a downtrend, double bottom, very nice resistance, and before the breakout, the market stuck to the level. There were multiple inside candles, and the breakout happened with a strong momentum bar. The market then moved up, came back into a retest pattern, a pullback pattern, and then shot up again. So very, very nice how we can put all this together. And don't dismiss inside and outside candles, but also don't use candlesticks on their own. Really put it into context to other charting principles to form a robust trading strategy. And then you can look at charts very, very differently and use them to time trades and to just make sense of price in a different way. And again, keep the support coming. Make sure to leave a comment below, leave a thumbs up, share the videos with your friends. If you want to learn more about technical analysis, either check the link in the description to my book, or if you want to take it to the next level, then check the link to my masterclass where you will see what I trade and you will learn how I trade as well.